Welcome back to my channel where I speak with all the business people out there in the Fort Lauderdale, in the Miami-Dade County, and very important, the Boca Raton and Palm Beach County. Today, we have with me one of my top social media person who does almost all of my videos. These great videos that you're seeing here on YouTube, on Instagram. It is Dennis from Media Component. Welcome, Dennis.
Moshe, thanks so much for having me. It's a pleasure. You know, I've been doing these videos for you for at least a couple of years now.
Definitely.
We're picking up steam and, we're branding you in the South Florida area.
Yes, you are.
It's been like almost 5 years now since you're
almost 5 years. Yeah.
5 years. So, I prepared a couple questions that I personally have that I'm going to ask for you. And maybe you can give some advice on today's episode.
Sure.
What people should do when it comes to retirement planning and investing. So my first question is, everybody says invest early and invest often.
Yes.
But what would you say one biggest mistake that people make when it comes to that statement and that you see over and over again?
Not only do people say invest often and invest early, one of those people is actually me, myself. That's one of the biggest things that I'd like to re-educate everyone. That timing in the market is a lot better than timing the market, where you need to, the earlier you start, the better the results will be. The S&P 500 returns around 10% a year over time.
Mm-hmm.
If you invest for a child, for instance, say $7,000 a year, when they're just born at 1 year old, do it for 10 years, that's $70,000 investment. Put in the S&P 500. When they become 65, that money, based upon compounding interest, compounding return, should be worth over $1.5 or even $2 million. That is what's time in the market, and not trying to time the market.
When it comes to high income individuals, what mistakes do you see that are most common in those asset classes?
High net worth individuals, they don't just think about today. They think about the entire family. They think about wealth management, but they also think multi-generational. So when you think about multi-generational, you have to think about trust accounts, alternative investments, getting a lawyer involved, and a great accountant. You cannot just work with one person. That is a big mistake. People do not understand that they can't just only think about retirement. They have to also think about today's investments for a house, for their children, for people who might be dependent on them financially. So retirement is a big thing. You also want to make sure that it's in a proper account. Again, trust accounts are very important.
My other question is, is everybody always speaks about real estate and real estate investing. In today's world, 2026, does real estate make sense with the high rates, with a lot of uncertainty in the market?
Yeah.
Is investing in real estate sound investment?
Everything investment-wise is a sound investment if you have time and what kind of dedication you want to put into it. Certain investments, you need to have a lot of hands-on, real estate being one of them. If you're looking as a real estate investment and actually buying the real estate itself, you have to go there and inspect it, make sure you have the right tenant, make sure you're not in a flood zone, make sure that the tenants pay you on time, you hope that nothing breaks. But over time, because real estate is an actual physical asset, everybody loves it. Over time, though, we could show you some great numbers on that. Over time, real estate returns are around 7 to 8%. But it's a real asset and people can hold on to it and people can always live in that real estate.
So what you're saying is if somebody's looking to invest into real estate, they have to be ready to do the property management. They have to be ready to go fix a plumbing issue or fix a refrigerator,
Right.
or if the roof is leaking, they need to have a a little bit of a cushion savings to be able to invest into repairs. And when you're talking about just one door versus like 10 doors, it doesn't make sense, and it's not as profitable with one investment compared to a portfolio of real estate.
100%. Now, you can hire a property manager, but that will eat into your profits. But property management is something that's very important. Yes, if you have one property, that's a great start. Then you could borrow money against it and buy the second, the third, the fourth. And that's how most real estate people did it. I know I've heard many of my clients tell me that back in the days, their parents or their grandparents, the way they got invested in real estate is they would have 4 or 5 families, sometimes 10 families even, get together, build a nice little pot where they all put their money and started buying one multifamily house, another multifamily home. And that's how they grew it. But nowadays, the good thing is that we have things that are called real estate investment trusts, where another institution goes out there, buys that real estate, invests it for you, does the property management for you, give you a monthly income, and then when they sell the portfolio, you get your money back, hopefully, and some profit on top, hopefully. There's no guarantees in anything. Neither is there a stock market guarantee, but that's what usually happens.
That's a great answer. So thanks for like breaking it down. So it really depends on a case-by-case personal financial plan to see where the money is best invested, into real estate or into market or into other products that you offer.
Correct. Right now, one of the hottest conversation is gold. Everybody wants to speak about gold. And we did a video about a couple of months ago when gold was really, really high at top. And I came out and said, gold at these levels is a little bit too high, and I wouldn't be surprised if it comes down. And it came down from about 5,400 all the way down to 4,300. So it was a big reduction. But over time, gold is a good investment or a hedge against inflation. But it can't sit still for 5 or 10 years and then it does a big spike. This is where the difference between the stock market, real estate, gold, and other investments that are out there. Stock market consistently goes up and down, but over time is up about 10%. Gold has other numbers, has other long-term returns. Same thing with real estate. Real estate can sit flat for several years and then have a big move up, like we had in COVID. Here, right now in Florida, even though the rest of the country is actually having still a good return on real estate, in Florida, things are starting to slow down. Maybe this is a good time to invest in real estate in Florida. I'm not a real estate agent. I will say that a good diversified portfolio should have a little bit of everything.
Great point. So I'm a big proponent of like passive residual income because that's really how I grew my agency, by offering residual services like website hosting, social media marketing. It's a month-to-month passive residual income where you set it and you kind of forget it. If you're hosting a website or if you're hosting AI tools, it's kind of like a software as a service. It's a monthly recurring revenue. So if somebody wants to get to the level of potentially having $5,000 of passive residual income, what would you recommend be the first several steps they should take?
It's a good question. It is a question that everybody is looking as the end goal, to have that nice passive income, but it has a lot of multiple answers. Number one, $5,000 income per month means $60,000 income per year. Are we looking before taxes or after taxes? Is this something for you at age 30, 40, 60, or 65, or during retirement? What is your income tax bracket when you're getting this? How do you get there? In order to get there, you have to build the nest egg, the foundation first. To get $60,000 in income per year, you will need, and it depends what kind of products we use. You can go to real estate. You can go into bonds. You can go into treasuries from the US government. The more risk you take, the more return you can get. Some of the vehicles that we have are paying you 8, 10%. There are some fixed annuities that are also paying you 3 or 4%. There are some variable annuities that are paying you even more. Am I a fan of all of these products? Some of them yes, most of them no. But this is more of a one-to-one conversation between the person that needs the income and myself, because every single individual has different needs, different tax bracket, and most importantly, different outlook on what they're going to do with this money. They have to also think about the foundation, the base, the principle. Do they want to pass it on to the next generation? Or are they going to gift it to someone else? Is it important for them to save it? Or, like I say, have a ski vacation? Spend your kids' inheritance vacation. Are those things important to you? So my answer to you, I know it's a very long answer, basic, you have to sit down with a financial advisor, but the most important is to grow that principal first to at least $500,000.
So just to summarize in a simple way, it's different for everybody, depending on where they are in life, what they have to invest. There isn't like a shortcut to get passive residual income. It could be different for different situations.
Definitely no shortcut. The only shortcut is $1 in a dream.